It is my pleasure to greet Sheila Bair this afternoon on your behalf. I don't think I need to introduce Sheila Bair, so I will go directly to the reasons why we think behind or beyond the honor she's making us by being here today, why we think that her presence and her intervention in this conference is so important. There's clearly two dimensions to this intervention. The first dimension is that given the experience she has and she has had in the US managing the resolution authority at the highest level in the midst of the crisis, she certainly has experience to share with us, say, Europeans. I know we have also non-European friends in the room, but this is the center of the EU machine at a time where we're discussing banking union, and as we all know, bank resolution and bank crisis management is a key component of banking union. So this is clearly one dimension why the presence of Sheila Bair with us today and listening to what she has to say about that, and perhaps what we on this side of the Atlantic can learn from her experience, is so interesting. The other dimension is really the topic of this panel. What does it mean having a financial system serving society? And this is clearly, given what she's written, something she's been thinking about, something she has a view about. And we will be very interested to listen to her view of what a financial system serving society is about. In the logic, and I know that Sheila has that sort of reasoning that we're mentioning this morning. We have different parties around the table. We've got the banks, financial industry, we've got regulators, civil society, society in general. Each of them have different arguments, and by definition, having a financial system serving society means that everybody needs to come to a common ground of what it means. So, without further ado, I will let the floor to Sheila Bair, and please welcome her with me.
Thank you, Thierry. It's very nice to be here and support the outstanding work of Finance Watch, which is so important to bring the public perspective to this ongoing effort for financial reform. And I congratulate Finance Watch for the really outstanding work that you have done in that area. Some people say we had a good crisis. I don't know if anybody had a good crisis. I am very proud of the work that the FDIC did, and I want to share with you some of the experiences that we had about what worked and what didn't, and what the framework is now under Dodd-Frank for resolving failing institutions. But I will tell you, it was a difficult, challenging time. Those 5 years I served at the FDIC, and one of the problems I had was that there was this relentless media skepticism about whether the FDIC had enough money to protect all the trillions in insured deposits that were in the U.S. banking system. And it got so bad, I was on a flight once going out to the West Coast to give a speech, and I was sitting in an aisle seat, and a young man starts walking down the aisle, and he looks down at me and he said, "Are you Sheila Bair?" And I said, "Yes." And he said, "Are you chairman of the FDIC?" And I said, "Yes." And he said, "Holy cow, you must be running out of money. They got you flying in coach." So I promptly stood up and announced to everyone, no, domestic is always coach, and we had plenty of money. But there you go. So there is a lot, even back then, there was a lot of skepticism. Can the government really protect insured depositors? Can the government handle these tremendous periods of stress and volatility in the financial markets? We did weather it well, though obviously there were some mistakes leading up to the crisis that should not have occurred. The response, though I think it worked, could have been better. We have better legal tools to deal with failing banks now, and that's really what I would like to discuss with you this afternoon. So, a financial services industry that serves the real economy, that's really what we all want, right? And we call it financial services for a reason, because the banks are supposed to serve the credit needs of the real economy, not the other way around. But I don't think you can have a financial services industry that meets the needs of the real economy if it is populated with too big to fail institutions. You simply cannot, the two are in Congress. And when I say too big to fail, I mean really, what you're really talking about is a market perception that because of an institution's size and interconnectedness, that the government is going to step in and protect their creditors, their shareholders, their creditors, their derivatives counterparties, that because of this huge volume of business they do and the interconnectedness, that the government is always going to come in and bail them out. And of course, this is not a good idea because it dilutes market discipline. It encourages people to deal with these too big to fail banks, thinking that they're going to be protected. You lose your market discipline, and you give them very advantageous costs in their funding structure. You give them incentives to use a lot of debt to fund themselves, and it makes the system much more unstable, excuse me. But of course, we had this too big to fail perception in the U.S. It was explicit with Fannie Mae and Freddie Mac. It was also the credit rating agencies explicitly gave our largest banks bump ups in their credit rating based on the idea that the government would come in and help them if they got into trouble. And then, of course, we ratified that in 2008 and 2009 with some pretty generous bailouts. And so now we have potentially even a bigger problem than we had prior to the crisis if we don't have very robust, clear tools to tell the public and to tell the market and to tell creditors in particular, no more bailouts. It is over. But, that's not to say that you don't want to ever intervene when a financial institution fails. And I don't, though I was a critic of the bailouts, I never suggested that we shouldn't do anything. We clearly did need to do something. But when you do intervene, what you want to do is protect the continuation of financial services to the people, the businesses and the consumers in the real economy who are relying on that financial institution for those services. And financial institutions are somewhat unique in that their assets are financial. So if you take the funding away, your franchise falls apart pretty fast, and you do have disruptions that you want to avoid. And this is one of the problems with traditional bankruptcy is that you just can't usually, not always, but usually, with a financial institution, especially one that doesn't have as much transparency as it should in terms of the level of the quality of its balance sheet, you can't get that funding in place fast enough. This is what happened with Lehman. So you have a full stop on the funding, and you can have a very disruptive situation. So this is one of the reasons why the FDIC for insured banks has always had a special process, independent of the bankruptcy process, to resolve failed banks. And it's a very punitive process. It's not in any way, shape, or form a bailout process. The shareholders are wiped out, the unsecured creditors are haircut, uninsured depositors frequently take losses too, consistent with our least cost test. But one of the things we can do, and have always been able to do with a failed bank resolution, is to provide liquidity support. And you want to provide the liquidity support because, the family that's planning to go to closing on their new mortgage the next week, you want to make sure they've got the funds for their mortgage. Or a small business that needs to use that bank's credit line to make payroll. You want to make sure that that small business can do that. Or, a builder, midstream in some construction project, they need another draw on their construction loan. You need that kind of, those kinds of credits you want to make sure keep flowing into the real economy, but you don't want to bail out those who invested in this financial institution, that is, the shareholders and the creditors. So there are some good reasons to provide liquidity support, though you should never, in my view, provide protection in advance or ex post or ex ante to the shareholders or the creditors of the institution. Now, so I think some intervention, liquidity support intervention to make sure credit flows continue can be justified. Some government intervention can be justified, but let me tell you a couple things that would never, ever justify intervention. One is this idea of interconnectedness. I just rankle at this idea that you have to bail out Bank X because banks A, B, and C are going to fail too if you impose losses because they bought the debt or they're the derivatives counterparties or whatever. They're going to go down too if you don't bail out Bank X. that having a situation like that it's just not forgivable, really. The regulators have the tools. They had the tools before the crisis. They have the tools now to reduce those credit exposure relationships. And there's a very specific provision in Dodd-Frank mandating that as part of the living will, the resolution planning process, large SIFIs, large financial institutions, have to identify their credit exposures to each other. And the Fed, our Fed, which is the supervisor for these large institutions now, the lead supervisor, has to limit those credit exposures. And they put out a pretty aggressive proposal a few years ago to put some very severe limits on those interrelationships. Unfortunately, those rules have been finalized. They've run into some serious resistance by the industry, but they need to be finalized because it's not just this idea. Again, you feed size and complexity if you reward this behavior. You reward them, being so interconnected by saying, okay, we'll have to bail you out if 3 other banks are going to go down. Even more pernicious, I think, is political connectedness, and this is something again that I think feeds into the public dissatisfaction and cynicism that resulted from the bailouts that we entered into in 2008 and 2009, was this perception of crony capitalism, and some banks, because of their connection, who was on their board or whatever, were getting breaks that others weren't. And that is bad from a market standpoint, creates all the wrong incentives, bad from a political stability standpoint, certainly atrocious from an ethical standpoint. And I think this is important to emphasize because as Europe considers how to structure their own single resolution mechanism and the authority that will have that resolution authority, what a really crucial thing for any effective, efficient resolution process, one with integrity, is insulation from any kind of political pressure. So, because it does, unfortunately, it can infiltrate decision making, and it shouldn't. So before I talk about how I think we're ending too big to fail in the U.S. and some thoughts about how that strategy might have some lessons here in Europe, let me just review a little bit why too big to fail is wrong. Because sometimes I think we have to keep reminding ourselves why we want to get rid of it, because you're not going to be able to structure a resolution mechanism that is going to end it. You need to have clarity of thought about why you want to end it. And first of all, as I've already alluded to, it's unfair. It promotes political instability. It creates most people don't get bailouts. I don't. If I buy a house at the top of the market and my mortgage goes underwater, nobody's going to bail me out. If I make a stupid investment and lose money, nobody's going to bail me out. So why should these very large financial institutions, whose managers get a lot of big bonuses and salaries, why should they get this special preference? So it makes people angry, and rightfully so. And it's dramatically inconsistent with a market-based democratic system. So I guess that is our sense of justice and fair play is important here in reminding ourselves why we want to end this pernicious doctrine. But even setting aside the morality and the emotion of it, which is justified and understandable, it's just bad economics because it makes your financial sector too big, and it encourages financial institutions to be bigger, right? The heads they win, tails we lose kind of mentality, so they can go out there and take as many risks as they want and juice up their profits with a lot of leverage, and if there's a problem, boom, they got to put on the government. That just encourages them to take risk, and that encourages creditors, shareholders and bond investors to skew investment dollars to them because they feel, they're protected. They've got to put on the government. And so the other parts of the economy, like manufacturing, energy, infrastructure, they don't get those kinds of government benefits, but you're skewing resource allocation to the sector. You're making it bigger. When we need a financial sector that's smaller, not bigger. I think that's pretty much true globally. It hurts innovation because it disadvantages the smaller competitors. So the big banks have advantages with their funding costs. It makes the smaller banks less competitive, creates a barrier to entry. Again, that's if you want a dynamic system, you don't want to give very large institutions this advantage over smaller competitors. And finally, it interferes with the market's natural corrective mechanism. And I think this is something we didn't do as well as we should have in the U.S. on this score, because I think one thing we did do that was not done in Europe, which should have been and can still be done in Europe, we did force our banks to raise raise a lot more capital through the stress testing process. But we did bail most of them out, let's face it, and we propped them up, and we didn't force them to clean up their balance sheets. So yes, we made them get in more capital, but we gave them many, many years to nurse their balance sheets and try to clean those up. And so we did interfere with the market's natural corrective mechanism, and this is not a good thing for our economy, because sick banks don't do a lot of new lending, right? Sick banks, they nurse their balance sheet, they play it safe, they'll take their cheap deposits and reinvest it, in government securities, or in our country, GSE securities, make a little bit of, risk-free spread, and they'll do that. They'll nurse themselves along until they get back into health, and they're not going to go out and make small business loans or anything else that's got, a scintilla of risk to it. They're going to try to play it pretty safe. Also, you don't want to reward bad management. You don't want to reward stupid business models or unsustainable business models. And again, if you prop bad managers up, if you prop unviable business models up, you keep them going. And again, you interfere with that natural corrective mechanism to let those institutions fail, reallocate those resources to managers that are doing a better job and business models that are doing a better job of serving real economic needs. So I do think this was a mistake that we made in 2009. We really kept doing the bailouts. We pretty much said everybody over $100 billion is too big to fail. We're not going to let them go down. And yes, of course, that did stabilize our financial system. But I think it did impede this natural corrective mechanism. And I think if we had been a little more punitive and forced them to take losses, get their balance sheet cleans up, I think we would have had a stronger economic recovery, because as it is now, we're still pretty sluggish, as you know. So we need to get rid of too big to fail, but we also need to recognize that financial institutions are a bit different in the kind of services they provide. So there does need to be intervention. There shouldn't be bailouts, but there should be intervention. And as I've said before, you never want to intervene just because they're interconnected, and you certainly never want to intervene just because they might have politically connected members on their board or what have you. But you do want to intervene with liquidity support to make sure that those credit flows keep going. You want to make sure, again, the family has their mortgage funded or the small business can make a payroll. And so that is really the trick that you want to provide. So again, with insured banks, we've always had that authority at the FDIC to provide that temporary liquidity support. We didn't have it with regard to non-bank financial entities during the crisis. So for the non-bank activity outside of an insured bank, that, if you didn't have other interventions, that went into bankruptcy. As we saw with the Lehman Brothers, bankruptcy did not work well. And maybe derivatives are another problem. The way derivatives are treated in bankruptcy is another problem that can make it a traditional bankruptcy highly disruptive for a financial institution. I understand you talked about that somewhat this morning. But one thing that the FDIC as a resolution authority can do that you really will never be able to get through a bankruptcy process is, one, being able to provide some continuity of funding so you don't have those disruptions and you don't destroy the franchise immediately by a full stop with funding. But you can also do some advanced planning, right? So you're a regulator. One of the things the FDIC has, which again, in thinking about the single resolution mechanism here, the FDIC actually has staff in these very large banks, in addition to having a planning process through what we call living wills and resolution planning. So there's a continual presence by the resolution authority in these large institutions, and as well as you have blueprints on the shelf that can serve as a guide. None of them are ever going to be perfect. Bankruptcy courts just can't do that. Another thing that a government resolution authority, especially appointed resolution authority, can do is work with other regulators, because one of the biggest challenges in resolving these very large multinational conglomerates is what do you do with the overseas operations. And so hopefully someday we will have better global agreements on resolution authorities and mechanisms, and I think we're going that way. But in the interim, the FDIC has basically entered into bilateral agreements with other countries to recognize the process, recognize the FDIC's authority as receiver if one of these large banks goes into a Title II resolution, to make sure that there isn't disruptive ring fencing with regard to the overseas operations, which can be bad for everybody. It can hurt the value of the franchise, the U.S.-based franchise. It can also impose unnecessary disruptions in terms of services being provided by that foreign subsidiary if that subsidiary is unnecessarily forced into an insolvency process in the foreign jurisdiction. So this is something that's, the FDIC has been working on this now. But I think it's important to understand in Dodd-Frank, we worked very hard to just ban bailouts. So the intervention that the FDIC can do is strictly limited to liquidity support. You cannot provide any support to shareholders. Unsecured creditors, the bondholders, have to be dealt with in the same kind of claims priority that you basically have in a bankruptcy process. We worked very hard to get that hardwired in Dodd-Frank, and there are really only two places where you can differentiate among creditors. One is just to continue essential operations. So technically, employees are creditors, the IT people, the security people, they're creditors, but you want to pay them. If you want to keep the franchise going and preserve any value in the franchise, you need to employ your employees and the providers of essential services. They might also be that you will actually maximize your recoveries if you differentiate among creditors. And the example I use with this, we found this frequently with failed banks, is that frequently when we would bid out a failed bank, the acquirer would want to pay us a premium to not haircut the uninsured depositors. They wanted to keep those uninsured depositors whole. And you think about it, this made sense because those are typically, some of the best bank customers. You don't want them unhappy, taking, a 20% haircut or whatever, and leaving your bank. So there were several where we didn't have that kind of a bid, and the uninsured depositors had to take losses. But frequently, those prices were bid up to more than compensate us for covering the uninsured depositors, and that's appropriate. And again, you would have the same kind of principle in bankruptcy. If by differentiating you maximize your recoveries, you can do that. But it's very hardwired and very punitive towards shareholders and creditors. It's also very hardwired and punitive against boards and executives. They lose all the top people lose their jobs, and that's typical of the way we deal with small banks as well. They're subject to a 3-year clawback of compensation. I mean, that's really harsher than what you would see in a bankruptcy. We can particularly see in a bankruptcy restructuring a lot of the management holding on to their jobs. So it is tougher on paper than bankruptcy, and I think that's appropriate. I think Dick Fold, if we'd had a Title II process, in early in 2008, if we'd had that process in place, I don't think we ever would have had Lehman, because I think Dick Fold would have figured out, well, gee, he had several, investors and other bidders who were interested in his bank, but he thought his bank was worth a lot more than they thought it was worth, which is pretty classic. And he also thought, I think, he was going to get a bailout because Bair Stearns, which was smaller and less interconnected, they got a bailout. But if we'd had Title II, first of all, Bair Stearns wouldn't have gotten a bailout. And second of all, he would have realized if I don't take care of my business, if I don't get some capital in here or break myself up and sell it, I'm going to lose my job. My board's going to lose their jobs. We're going to lose 3 years of our compensation. We're going to be broken up and sold off by the government. So I think you would have had a very difficult, very, very different result. So it's again, you get that market discipline, you get that motivation for managers to fix their own problems, not to look at taxpayers, if you have a very hardwired and clearly harsh process for those who have made the mistakes, who are responsible and should be held accountable. So that's the framework. So I think a lot of people say, well, come on. $2 trillion institution, this all sounds nice on paper, but can the FDIC really handle the failure of a very large multi-trillion-dollar institution? And I do think they can. I absolutely do. I think the tools are there. The strategy is there. I think it would be messy. I think there's a lot of work left to do to make it work as well as it should. If we had to do it now, they could do it. It would be messy. It would be unnecessarily costly, but I think they could. And the way they are going to do it, and they've already announced this, and have done a lot of analytical work, which is on their website, which I would commend you all to read if you're interested, is what's called single point of entry. So in the U.S., our large conglomerates are mostly funded at the top of the house. So they have a holding company that owns everything else underneath. And the publicly traded equity and debt is issued out of that holding company, and then the funds are funneled down into the operating subsidiaries. So if you take control of the holding company, it's kind of, I analogize it to a jellyfish, with thousands of different tentacles, because that's kind of what the legal structure of these large banks looks like now. And over time, that needs to be simplified, as I'll talk about in a minute. But for now, really the most realistic way to seize control one of these institutions, if it is failing, without resorting to a taxpayer bailout, is by seizing control of the holding company, making sure and right now there's quite a bit of equity and unsecured debt at the holding company level at most, not all, but most of our U.S. banks. That's all available for loss absorption. Keep the operating subsidiaries that are the ones that are providing that credit, the mortgage funding, the line of credit, the small business or whatever, keep them open and operating, but any losses associated with the resolution will be absorbed by the shareholder and the creditors, and that's appropriate. Now, a couple of important things that need to be done to make sure that that works as well as it should. One is, as the market is starting to figure out that this is what's going to be the FDIC strategy, you're already starting to see a little gaming going on, because one of the disadvantages of this strategy is if you're a funder at the operating subsidiary level, you're going to think, well, gee, wait a minute. If I invest in the holding company, I'm going to take a loss. If I invest in an operating subsidiary, I'm probably not going to take a loss. So I'm going to start investing in the op sub. I'm not going to invest in the holding company. And the funding cost, and the banks will have an incentive to do this because the funding cost will be lower at the operating subsidiary level than at the holding company level. So to avoid any kind of gaming like this, it's important for the Fed, which they have announced they are going to be doing, and I think the rule is going to be coming out shortly, I hope it is, to have a minimum long-term debt requirement at the holding company level to make sure that there's plenty of loss absorption capacity at the holding company level if one of these guys goes under. And that will also have the nice effect of making them fund longer term too. Short-term funding obviously was a big problem during the crisis, and there are differences of opinion. I've gone as high as 30%, so having an equity stack, equity sub-debt and senior unsecured debt with a duration of greater than a year, if I had my way, you'd go up to 30% of total non-risk-weighted assets. Now, we don't count as much on balance sheet as they do in Europe, so that number, if you were talking about IFRS, that number should probably be less. I think our industry is about at 13% risk-weighted assets, so that's way too low, but at least they're acknowledging that there's a problem, that we need to have some type of minimum requirement. But I expect the Fed to be moving very shortly on that. And we've also had rules that I think it's important, though, in moving forward with this, to make sure the market doesn't understand that's not the only thing that's available for loss absorption. We want to make sure that that's there. If short-term debt should also and is available for loss absorption under the U.S. process. The problem with the short-term debt is it will run frequently it will run before the bank actually fails. These failures typically don't occur overnight. Maybe the popular lore thinks that happens, but they don't. I mean, Lehman was a slow burn for months. The short-term debt didn't actually run on Lehman because I think the market thought there was going to be a bailout. But usually, and certainly we saw this with our failed banks, the short-term debt runs. So you've got to have debt with a minimum duration of at least a year to make sure by the time the place fails, there's still a good stack of unsecured debt that can absorb losses. Is also be available to convert into equity to recapitalize whatever new institution or institutions emerge out of the receivership. Another thing that needs to be done, and I note the FDIC and the Bank of England just sent a letter to the International Swaps and Derivatives Association, or ISDA, this week asking that they change their documentation for swap instruments so that the swaps no longer have an automatic right to terminate just because a SIFI goes into the U.S. resolution process under Title II of Dodd-Frank or whatever resolution mechanism might be applicable in Europe. And that's important because right now in the U.S., the law is if it's a U.S. counterparty, they can't terminate. So Dodd-Frank is very specific on that. The FDIC's receiver has not very long, basically a weekend, to tell counterparties whether they're going to accept or repudiate their contracts. But if they accept the contracts, the derivatives counterparties have to continue to perform on their contracts. They can't pull out their collateral and walk away. But in a bankruptcy process, that's not the rule. And in for foreign counterparties who are not subject to U.S. law, there is still a fear that they could terminate their contracts and walk away, which would be disruptive. So ISDA has the tools to fix this by changing their contract documentation. And I hope they, people have been talking with them informally for a couple years now. So, boy, if there are any ISDA members out here, would you step up and get this done? I mean, I think the large banks want everybody to believe that too big to fail is over. They can fail. No more taxpayer bailouts. We all want to get there. But this is like a one easy thing that the large financial institutions, which basically run ISDA, could do to make sure that this resolution process works as well as it should. Longer term, what we really need to do is get these banks to simplify. And I like ring fencing. So I think the single point of entry idea in the near term is really your only viable option for U.S. banks, at least, with this huge tangle of legal entities that they have. Longer term, though, and this is pretty much directed under Title I of Dodd-Frank as well, the regulators need to be getting them to simplify their legal structures, align these thousands of legal entities they have, reduce the number first, and align them with their business lines. So, if you have a problem in your investment banking, and the commercial banks, fine, be able to hive it off, or maybe even put it into a bankruptcy process. But right now, they're so tangled and interconnected that that's very difficult to do. So that really, over time, and I think we need to use more of international subsidiarization too. So if there's very large operations in a foreign jurisdiction, it would be fine with me. Here's a hint. If European countries want to tell our banks to subsidiarize, just as our Fed is saying, if you're going to be doing business, if you're of any size and you're doing business in the U.S., you need to subsidiarize and have an intermediate holding company and meet our capital standards and our liquidity standards here. That doesn't bother me one bit. I think that makes for a more stable system. When you get into times of stress, it will make sure you have better capital and liquidity in each jurisdiction to support that bank's operations. It will mitigate the contagion risk that we saw so profoundly in 2008. So I think those are all good things. So simplification, subsidiarization, longer term, and that will give regulators more options in terms of how they resolve these banks. If you make the business lines more easily severable and you make the international operations more easily severable when they get into trouble. An added benefit of doing that, particularly if it's disclosed publicly, is you will empower shareholders to get a better sense of whether these very large institutions are really present good shareholder value. Right now, these complex legal structures, they act like a poison pill. So there are some shareholders that they're looking at their returns, which have not been so great, and they're saying, well, maybe, and they're looking at the regional banks in our country, which have been doing a lot better than the mega banks, and they're saying, well, maybe this place would be worth more in its component parts than as a big consolidated blob. But the complexity and the opacity of the legal structures right now, it's really a poison pill. I mean, you want to see what your bank would look like broken up, where do you start? You can't even understand it. And there was a nascent shareholder effort, an activist shareholder initiative, to get Citigroup to at least do an analysis of what they would look like broken up and what their value would be broken up. And unfortunately, the SEC staff gave the Citigroup management a no-action letter, so they didn't have to put this request on their proxy, which I think was unfortunate. I think that's really what shareholder proxies should be doing. How do we value our company, and how do we figure out how our company might be more valuable? But there's been some really interesting bank analyst reports coming out. Mike Mayo did one earlier in the year. He looked at the 50 largest banking organizations in the U.S. over the past 10 years and how they performed. And the three largest, Bank of America, Citigroup, and J.P. Morgan Chase, by far performed as a group more poorly than the rest. They had the worst stock returns, they had the worst returns on equity and assets, they had the worst revenue, they had the worst efficiency ratios, and they had the worst volatility in earnings. And you can probably guess the place where they did better. Compensation. There you go. So so I think there's a real issue. These places are just, you get a lot of management inefficiencies when you get institutions that are this big and this complex. And if we empower shareholders, get better information, plus convince them and bondholders, no more too big to fail, you're on the hook now. Get this implied government subsidy out of the market's perception of these too big to fail institutions. I think you should see some real meaningful market dynamics working to make them smaller, simpler, or even break up. So, but I think, again, having a credible resolution mechanism in place, convincing the market it's over, is absolutely essential. So, before we go to the Q&A, just let me share some thoughts about as I understand, where Europe is in developing its single resolution mechanism, at least based on the U.S. experience and what I saw during the crisis and running the FDIC, where I think priorities I think you should really focus on in developing your SRM. First, as I said, hardwire against bailouts. Don't leave wiggle room. Hardwire it. There is always a lot of pressure to do bailouts. There's political pressure. There's just generalized fear, and it's a lot easier to write a big check when a big institution gets into trouble. It's a lot easier to write a big check, throw a lot of money at them, than actually doing the hard work of putting them into receivership and cleaning them up. But you want to put them into receivership. You want to clean them up, because that's going to have a better result for your economy, for your real economy, and you're going to get market discipline out of that. You bail them out, you write a big check, that might take care of your immediate problem, but you're going to be making your system more unstable long term, because again, they'll go out and take risk. If they think they've got to put on the government, they're going to go out and take risk. A hardwire against bailout means, having a claims priority. We put the claims priority in the Dodd-Frank statute. The receiver is required to minimize losses. The FDIC can't throw up its hands and say, oh, we're worried about system stability, we've got to do a bailout. You just can't do it. It's just prohibited. And again, I think that you want it hardwired. If you're going to get the maximum benefit from a single resolution mechanism, it has to be hardwired against bailout. Again, you need political insulation. You need, we have the FDIC as an independent agency. We had a huge inspector general that audited us all the time. I loved it. Because I will tell you, during the crisis, I can't tell you how many phone calls I got from politicians who would kind of sheepishly say, was so-and-so constituent, was a stakeholder at this failed bank, and can't you help them out, and all this kind of stuff. I said, no, even if I wanted to help you, my statute prohibits it. I've got this IG overlooking my shoulder. You want all those weapons and tools to be able to protect your resolution authority against any kind of political influence, because it's not a happy thing when a bank fails. People will take losses when a bank fails. That's the way the process should work. But sometimes those people can be quite politically connected. So you want your SRM to have significant political insulation and independence. Otherwise, you're going to be making their job very difficult. Consistent with that, they need to have autonomy to make decisions. So you need a nimble resolution mechanism. You can't resolve a bank with a committee. It just can't happen. For your economic needs, to make sure the good parts of the bank continue and those credit services continue to flow. You want to be able to, if you've got ready investors, if you can break it up quickly and recapitalize it with new investors, and send it out into the private sector, that's probably what you want to do. But to have to go through a very elaborate, 23 checkouts process, that's just not something that's going to work. You're not going to get your best efficiency out of your resolution mechanism if it's too much of a committee process. So define the rules, hardwire the rules. Define what your resolution authority can and cannot do, but then let them do it. Let them make decisions. Don't make them come back to various different interests to get approval for this and that. And then finally, consistent with the ability to move quickly and nimbly is advanced planning is key, and I understand a component of the SRM being developed here is the authority to do what the living will process, the resolution planning, getting that information, those plans directly from the banks. I think that's absolutely essential. I think your SRM should have the ability to go into banks, interact with them directly, get information from them. It's essential to be able to react fast by having people on the ground who are familiar with those banks, know how they operate, know their business model, know their organizational structure, And that can be done. We have backup authority at the FDIC as well. That may or may not be feasible here, but at least through the living will planning process, make sure the SRM authorities can go into these banks and directly access information. So good luck. I think I really commend the folks here at the European Commission, the European Parliament. I know how much hard work there has gone into this. I know your decision-making structure is as complicated as ours is and as dysfunctional as we can be in the U.S. I know the challenges here are substantial as well. So I congratulate you. I wish you luck. I hope this has been helpful. If I can help again in the future, I would love to do that. And we'll go to Q&A now. Thank you.
Do you want to sit there? Yeah. Sheila, thank you very much. That was fascinating. And it had me thinking, as Sheila Bair, as head of the SRM, taking calls from politicians from not just one country, but 18.
Right. Well, I got a reputation after all. I think they were afraid to call me. So.
Well, the one thing I learned about you, actually, in 2006, when I became a fan, was I wrote an article for The Economist about the leverage ratio and the trouble you were causing with the Bail Committee. And I thought, at least there's one regulator who isn't captured. It isn't the capture. So,
thank you.
Yeah. I'd like to ask, before we open to the floor, which we'll do very, very soon, I'd like to ask, you now reckon you have a resolution structure in place in the US. Would you think that in Europe one has to get that structure in place before we go to this structure issue, the bank size issue, and all the rest of it? Or can these building sites work?
No, I think you can use parallel tracks for them. I think any size restrictions and the Lincoln report requiring better ring fencing and better clarity of where the business lines are and better segregation and separation, those will all make resolution easier. So I think they're very much complementary. I don't think you certainly need to wait to set up the SRM for those decisions. Not at all. No.
Yeah, and likewise, resolution, you suggested would still be a mess in the States.
I think it will. I don't want to suggest it would be easy. I don't think anybody this is going to be like a small bank failure that you can just get it done overnight. I think it's going to be difficult, but I think it can be done, and it will be used. I have no doubt. I think the result is there to use it.
But doesn't the demand for more subsidiarization and that kind of pressure, which is coming in Europe, to spell the end of globalization, as the investment bankers would love to know it?
So I hear that a lot, and no, I don't think so. Look, they love to not subsidiarize. They love to be able to move capital and liquidity around wherever they need it, right? That's cheaper for them to operate that way. But what if you need it in the U.S., and you need it in Europe, and you need it in South America, and you need it in Asia? You don't have enough capital for all those places, and that's exactly what happens when you have a global meltdown. You need it everywhere, and you don't have it. So it makes the system more stable, and yes, incrementally it's more expensive, but there are some banks that do it already, and they seem to be able to function and make a profit just fine.
And you reckon that the single point of entry is the way to go, that multiple...
Right now it is. I think right now it's the only way to go, and thank you for asking that question, because long term I don't think that's the optimal solution. I think now, given the complexity of their legal structures, that single point of entry is really the only feasible way to do it in an orderly way. But over time, they should be forced to simplify and be able to show that they can hive off their different business lines, so you would have more options. You might be able to just, put the investment bank into Title II or even put it into bankruptcy. Again, the derivatives treatment in bankruptcy is a problem, but over time, that is what regulators should be looking to do. Absolutely.
Just one more question before I open it up to the floor. We hear a lot about Lehman Brothers.
Right.
If Lehman hadn't happened, would we be missing a lesson? Do you think we actually had to have a Lehman Brothers to give us an idea of how badly things could go?
That's an interesting question. Certainly Lehman, as painful as it was, underscored just how fragile and interconnected and over-levered, frankly, that the financial system was. So if we're going to take a positive out of it, maybe it did wake regulators up better. And the industry, hopefully itself, they've learned some lessons about how unstable the system was, that one $600 billion investment bank could have these kinds of cataclysmic consequences. Yeah, I think there's something to that. Yeah.
Okay, I can't see very well, but would you, two gentlemen over there, yeah, so the guy next to Harold Schumann. And then
good afternoon. Yeah. My name is Philip, working for German MP of the Green Party. My question is, the overarching goal is obviously to make finance serve society, and you also spoke about the role of banks in that overall structure. So my question is, what role does the FDIC play in incentivizing good banks, and how do you use basically risk premiums, for example, being paid to FDIC to prevent moral hazard from, subsidizing risky business models, and does it have an impact?
Right. Well, I think it does. We had just gotten the authority to adjust deposit insurance premiums based on risk when I got to the FDIC in 2006, and so we put the initial system we put in place. I don't think differentiated enough, and unfortunately, with the crisis, we didn't have time to go back until after the crisis to try to make some adjustmts. But we did before I left. We did change it fairly significantly, including a very separate system for the largest institutions. I think one thing that we did that was important was give penalties, significant premium penalties, for those who rely heavily on collateralized borrowing to fund themselves. That definitely, that makes the institution less resilient because you have a lot of good assets that you can't sell off into the market if you get into trouble, they're tied up. But also it makes the resolution much more expensive. So that was, and we said you couldn't, but that, we wanted you to fund long-term, so we gave incentives to that. We also said that another bank couldn't hold it, because that's the other problem. You want to make sure that they issue lots of long-term debt, but you also want to make sure other banks don't own it, or you've got this interconnected problem again. So I think, and again, I hope the SRM, I understand, will have a pre-funded resolution fund, and that they will have the authority to charge assessments on the basis of risk. And I think that can be a very good tool to incentivize less risky behavior and more stable funding sources.
Mm-hmm. Behind? Yeah.
Christian Chavagneux, I'm working with the French economic magazine Alternative Économique. This morning we had a discussion about the leverage ratio. Right. We know that the US authority, the British authorities, the Swiss authorities, the OCDE are pushing for a much higher level than the 3% put forward by Bair 3. You've been negotiating these issues internationally. You know as much as we do that the French and German authorities are refusing to increase this ratio. What do you think is their real motivation? What will you say to them to change their minds? Yeah. And if I may ask you a second small question on a different issues, how far do you think that tax havens, or maybe we should call it prudential havens, are contributing to increase the systemic risk in the global financial system? Thank you.
Right. So yes, I think the banks here, I think the banks in the U.S. are still over-levered. The problem's a bit worse here, and I wish the French and the Germans would, think more about their taxpayers on this. I mean, every dollar of equity that's there that they add to their banks will protect their taxpayers from potentially having to take losses. And unlike in the U.S., at least on a cash flow basis, our bailouts made money. I hate to say that. It's not a rationalization, but on a cash flow basis, not a subsidy basis. But I believe in Germany, they've cost taxpayers quite a bit. So there's a direct trade-off. And the thicker that cushion of equity, the less chances that they're going to fail. And if they do fail, that there's going to be plenty of loss absorption to insulate the innocent bystanders from having to step in. So, and also, let's face it, if you let your banks operate with that level of leverage, you are endorsing too big to fail. Because there's no investor in their right mind that's going to buy the debt of one of these big banks if they're operating at, 50, 40 to 1 leverage. They're not going to buy the debt unless they figure, the government's not going to let a Deutsche Bank go down or whatever. So they are implicitly endorsing too big to fail by allowing those really high levels of leverage. And I know it's, it hits the return on equity. But you don't want, and frankly, investors and banks being the ones that want these outsized double-digit returns. I mean, let's have Aunt Minnie come back in and be a bank investor, right? And she'll get her usual dividend, and that's fine. And she's exactly the kind of person you want to be owning bank shares. So there are trade-offs, but let's face it, are the trade-offs that the bonuses get smaller, that the juiced returns on equity get smaller, and do we care about that? Should taxpayers care about it? This idea that it's going to hurt lending is just, I think that's been debunked. I keep hearing it over and over again, but better capitalized banks do a better job at lending, no doubt about it. All the data that we saw in the US, and I think there's similar data in Europe, Mervyn King has spoken about this. The better capitalized banks were the ones that did a better job lending. And lending in a downturn, which is when you need them to lend. In good times, anybody will lend, right? It's in bad times where you want them to be there for you. And over-leveraged banks are not there for you.
There was a second part of that question about prudential havens.
Feeding systemic risk. Yeah, I mean, this whole, and it's related to the leverage ratio, so that the way the bank regulators risk-weighted assets absolutely created this herd mentality. The first thing we did was allow banks to use their internal models to say how risky their assets were, which impacted how much capital they had to have. So we gave them incentives to start using their models to game their capital as opposed to use their models to manage risk. So that was a problem. But even in some of the standardized risk weights, we just made errors, and things that really had been given more careful thought we wouldn't have done. So CDOs, who the heck could understand what a CDO was, or CDO squared? But hey, if it had a CDS, it was wrapped up in credit default swap protection, written by somebody like AIG, zero risk. You use all the leverage you want on that. Repos, you still can use 100% leverage on repos. So just to say these things are low risk when they're really not, you create a herd mentality to go into these asset categories, and then when you have a meltdown, you've got a lot of banks with the same thing on their balance sheet with very little, if any, capital against them, and that's what we saw in 2008.
One more question over there. Yeah.
Harold Schumann, reporter from Germany. If I've understood you right, you said, don't be afraid, even if Bank of America or JP Morgan or Goldman Sachs fails next time, there will be no other bailout. We have all the instruments needed and the legal frame to resolve even these big institutions. Why then do you think the rating agencies still grant bonus points for too big to fail for these exactly banks? Do you think they didn't get it, or?
Well, I think, first of all, you asked me to express, a lot of people who pays attention to what rating agencies say, period. But and I shouldn't say that. In some areas, rating agencies perform pretty well. So look, I think this is a mistake. I told them that was at the FDIC. They have reduced some of the bump up. I think they're just still skeptical whether the regulators will actually do it. I think actually they're even more worried, not so much about whether the FDIC and the Fed will use these tools. I think they will. They're more worried about, again, the political pressure and Congress coming in and authorizing another bailout. I think that that's not going to happen because a lot of members lost re-election or had very tough re-election when they voted for TARP. So I don't think if people, if the rating agencies or anybody else is betting on a congressionally approved bailout, I don't think that's going to happen. But at least when I talk to them, that's what they tell me. And I want to say, I don't want to overstate. I don't want to see a big bank fail. Fear may be too strong of a word. I would view it with trepidation. Again, I think it'd be messy and costly if it happened now because there's still a lot of groundwork that needs to be laid. But I do think that they have the tools and would use the tools to resolve these entities without taxpayer bailouts. Absolutely.
I don't think it would work in Europe, in the Eurozone, though, because we have this fudge.
Right.
With the sovereign bonds, the risk weighting of sovereign bonds, which means that that's a sort of kind of forgiveness before you start.
Right. Well, you do have that problem, and that is, that's probably a larger, dealing with that is probably a much larger discussion about, eventual fiscal integration here, and that's, I know, will be a long time coming. So I think, that is what it is, but the capital framework, if you had a leverage ratio, some of those incentives to load up on sovereign debt would not be there because the leverage ratio is not risk sensitive. So if it's 5% advocated 8%, you have to use that much common equity to fund those investments. For right now, it's zero risk, so they have every incentive to load up. And again, without a leverage ratio, they can boost their capital numbers and still be loading up on assets that really are not safe at all.
There was a question right at the back there. Several. Okay.
Diego Valiante, Center for European Policy Studies. You know that the ECB will take over the role of a single supervisory mechanism in the Eurozone. And one of his role will be to define when a bank needs to be liquidated. The question I want to ask is whether the FDIC had signals from the Fed about banks that needed to be liquidated,
Right.
and whether in the asset quality review that the ECB will do, whether it should take into account the review for liquidating banks or for giving them another LTRO.
So
That is a conflict.
Yeah, so I think that's a really good question. The FDIC generally would rely on the primary supervisor to say whether a bank was insolvent or it will soon be insolvent, couldn't meet its liquidity demands. But we always had the backup authority to make that determination ourselves if the primary supervisor we didn't think was doing its job. And the reason that's important, and look, the ECB is obviously a top-notch operation, so and I understand the way they're structuring this is that their supervisory part will be pretty separate from the monetary policy piece. But nonetheless, my experience with primary supervisors is sometimes their own egos and reputations can get wrapped up in that of the bank. And it's hard for them to admit that the bank they've supervised, right, that they've had responsibility for is in trouble. So sometimes they may not always be as quick enough as they should to acknowledge those problems. And having another authority with the ability to come in and say, no, we think we have a problem, that in and of itself is a disciplining tool. And with the FDIC, we hardly ever had to. I think there was one time when we actually had to come in and say, you know, we're pulling the trigger on this bank, because the primary regulators, just knowing that we had that authority, I think it just kept them on its toes a little bit more. So, but that's certainly something to think about, because sometimes the primary supervisor can have a conflict. And in any event, whether the SRM has the independent authority or not, the ECB should have metrics, which we call it prompt corrective action in the U.S., that are somewhat hardwired. So as capital deteriorates, or bond spreads increase, or whatever, the Fed's working that out now for the non-banks, what the triggers should be. There is increasingly aggressive supervisory intervention. At some point, you just got to say it's time to pull the plug. So, having that kind of system of triggers, which to be as objective as possible, I think would also, and that would help the ECB as a supervisor too. Because again, supervisors, just like resolution authorities, can be subject to different types of political influences. Having it as hardwired as possible is always a good thing.
There was another question at the back there, and then one in the front.
Hello, my name is Gudrun Johnson. I'm from Iceland. We had 99% of our banking sector crumbling down in 2008. I was involved with the Special Investigation Commission set up to look into the causes of the collapse of the banks. One thing that you touched upon and that we found also interesting in our investigation was the part of the holding companies of the banks. Mm-hmm. So you wonder, once you put so much emphasis on the equity ratios of banks, and that is the reason why supervisory authorities would eventually go in there to do something. You have holding companies holding the shares, right? But those same holding companies are leveraged.
Yes.
So is it really an equity that they provide, full equity, and if so, shouldn't the so what's your view on the holding company ownership structure in general? I guess that's a small question. And shouldn't they be subdued to the same scrutiny as the banks themselves?
Right. So you're right. So because you have the risk of double leverage. So so an insured bank, the operating subsidiary of a holding company, you could have a highly leveraged holding company issuing a lot of debt, taking the proceeds and buying equity shares in the bank, and so the bank is reporting a really high capital ratio. But in point of fact, that's all levered money coming from the holding company. So you have to focus on what the consolidated equity position is. You can't just look at the operating subsidiaries. And if you want your holding company to be a source of strength, look, I take holding companies as a point, as a fact of life that I can't do anything about. So you have to deal with it, at least in the U.S. It's not going away. But making sure there's a very thick equity cushion, then also long-term debt, which can be converted into equity to recapitalize a new, healthier bank, I think, is absolutely essential. One thing related to this that concerns me, our regulators have moved to increase the leverage ratio requirements, what's called the Basel III leverage ratio, which is, it's got a bigger denominator than U.S. GAAP assets. So there's a lot, it's not completely IFRS, but it's got a bigger denominator. So the U.S. regulators are suggesting 6% for insured banks and 5% for consolidated capital, and that concerns me a lot, because if you're just looking at you're placing primary reliance on strong capital levels at the bank level. For instance, if you're at JP Morgan Chase and almost all of your assets are funded inside the bank, if you've got say 80% of your assets are in the bank, if you have a 6% capital at the bank and a 5% consolidated, you can have 2% capital funding everything else in your holding company. What happens when they have losses? I'll tell you what happens. It collapses back into the bank. So it's absolutely essential to make sure there's real common equity at the holding company level to avoid just this problem. And thank you for bringing that up, because a lot of people don't understand this double leverage
The Australians
issue.
apparently have an answer to this.
Exactly.
The non-operating holding company.
Yeah, I've heard.
Which can issue
Adrian
equity, according to Adrian Blundell-Wignall, but not debt. So
Right. I'd be all for it. Talk to the Fed.
We want the Australian model.
Yeah.
There's a question here in the front.
Thank you. Stefano Mazzocchi from AFME, the Association for Financial Markets in Europe. I found very, very interesting and very important what you said about the need to have confidence on the fact that these resolution tools that have been designed or are being designed will work, even if it will be messy and difficult. But that's a very important message. And as highlighted by the previous speaker on the problem of the credit rating agencies, that they also don't have that trust. I think this lack of trust might be undermining also what we are doing here in Europe on the Bank Recovery and Resolution Directive. I mean, this discussion about having flexibility on the scope of the bail-in, the proposal of using the resolution fund to absorb losses, this idea of having the government, so-called government stabilization tools to do whatever it takes. And to some extent, we might disagree on this point. To some extent, also the discussion on the ring fencing might be a result of this lack of trust on the resolvability assessments and on the resolution plans to work the way they should. So my question is, how can we strengthen that trust? How can we make sure that these tools are credible and there is confidence that they will be used in an effective way?
Right. Well, I think the statute itself needs to hardwire this, and I think the ball's really in the court of the European Parliament, it sounds like to me. But I think we got our Congress to hardwire it in the statute. One of the first thing I did was then I'd put implementing rules in place, reinforcing that this is what's going to happen. These are the claims priorities. This is going to take losses, and accept that. And so, look, this is absolutely. I think you need to emphasize the folks at the European Commission who have been developing the template. We need to work with the members of the European Parliament to understand the importance of this. It is absolutely not worth doing, and you could have a worse situation if you end up with this very fuzzy, construct that the market, there's a lot of wiggle room in it and a lot of different decision makers and, potential for gaming it and political influence. That's not going to work. It just won't work. And so I hope if you're going to go down that route, then just don't do it. But the people I'm talking to, I think there is increasing understanding that this really does need to be hardwired.
I think we've got time for about one or perhaps two more questions. Maybe one over there. Yeah.
My name is Enrique Velázquez from the European Banking Federation. In addition to a clear legal framework, in addition to the authority, in addition to the adequate toolkit, I would like to hear your views on a number of US-specific things, I think, that may have facilitated the task of the FDIC, and things that I think we do not have in Europe, namely the existence of a fully integrated banking system in the United States that, for example, would see the banking champion of Nevada being taken over by a bank in California, the existence of a very deep market for distressed assets, and a common understanding, for example, of the insolvency regime and Chapter 11 and all these things. These three things, I think, and perhaps there may be others we do not have here in Europe. So how instrumental have these things been in the context of the US to facilitate the task of resolving banks for the FDIC?
Right. Well, it has been easier, but I think ultimately that's why you need banking union, right? You need to stop thinking about Spanish banks and German banks and French banks. They need to be European banks, and that's going to, you're going to have to transcend nationalism to get to that. And I understand that's difficult. That's a struggle, and there's a lot of wonderful history for each of the individual nations that comprise the EU. But if you want true banking union, you're going to have to transcend that. I think otherwise you're not going to get the benefits. That's absolutely right. But the individual nations, letting these big banks fail locally, they, as Mervyn King said, they operate internationally, but they fail locally. That just doesn't work. I think that's why you need SRM, and that's why it needs to be a common framework with rules for everybody and the same rules for everybody, and that will require, like a lot of these issues, individual nations giving up some of their prerogatives and some of their identities towards a broader banking union.
There was a time when there wasn't interstate banking, is that
That's
right?
exactly right. Well, no, we had our problems too. I mean, granted, it was a different situation, but yeah, absolutely. We've pretty much, those have gone away now, but that was a long history as well, getting interstate banking in place.
Sheila, I'm going to have to stop it there. Yeah. That's been absolutely fascinating.
Good.
Thanks so much for giving us the wealth of your experience.
Thanks for having me.
And I'd love to congratulate you.